Hello everyone. In this lecture, we are going to talk about the ratio analysis of financial statement and how the auditors can use these ratios in an audit to facilitate their decision or to facilitate the formation of their audit opinions. Generally, there are three parts of this lecture. In the first part, we're going to spend a few minutes to review the preliminary analytical procedure in an audit, and then in the second part, we're going to discuss the ratio analysis of financial statement in details, like what kind of ratios that we usually calculate when we analyze the financial statement. And in the third part, we're going to use a case to demonstrate the usage of ratio analysis in the audit procedure. So first, let's begin with a brief review of the preliminary analytical procedure. It is a section of Rutgers faculty Helen Brown's auditing class.
So let's just talk a little bit more about preliminary audit analytic procedures. So with preliminary analytical procedures, what we're doing in the planning phase, that's what we mean by preliminary analytical procedures, is that it's attention directing, right? We're trying to identify where there might be potential problems. Okay? This too is also a part of the first part of your case, right? You're going to have to look at the financial statements and perform some analytical procedures. Attention directing, right? So also it provides a way for you, the auditor, to kind of think about a starting place in terms of the financial statements, where to start, okay? Help them identify risk. Identify any unusual changes in the relationships in the data, right? So if you see that sales has doubled, for example, but you don't see a corresponding change in the allowance for doubtful accounts. Maybe there's no problem, but you kind of expect to see as sales go up, you see accounts receivable increase, and you would expect to see some relationship to allowance for doubtful accounts perhaps. What you're going to do at that point is not say, okay, there's a problem, it's a potential problem. What could be the cause of that problem? And trying to understand and evaluate what could be wrong is where all of your other sources of information come into play, right? If you understand the industry or you understand things that impact the client's business, you're able to make a decision or at least an assessment of whether or not that relationship makes sense or whether that change in number makes sense. Does it make sense in relation to the industry? Does it make sense in relation to what you know about the client? You have to try to identify and you say, okay, well, what are some of the reasons for that? So, for example, if you see that, property, plant, and equipment, let's say, if you see that debt went up a couple of $1 million in 1 year, that's going to raise a red flag, or it's going to, make you, it's going to get your attention. However, if you read in the board of director minutes that they got a line of credit increase, well, that would account for the increase in the debt. But you'd also want to know, well, why are they getting the line of credit increase? Why are they getting such a significant credit increase? What's going on? You would expect to see somewhere in the board of directors minutes perhaps that they have a capital improvement project, which would account for why they were borrowing funds. So you'll see that you get different, getting the information from different sources to be able to try to make or give a legitimate assessment of what the problem could be. In terms of your analytical procedures, I think I talked about this before, you have to develop an expectation. So if you don't have an expectation, it means nothing, right? So if you're looking at the financial statements and you have no knowledge of the client, you don't know what they did, it means absolutely nothing, right, to perform that analytical procedure. define what a significant difference would be. And when we talk about materiality, we'll talk about that a bit more. Calculate predictions and compare them with the recorded amount. Investigate any significant differences. And then document each of the above steps. Always, always, always you're going to document, right? Because your audit, at this point now, you're auditing. It's preliminary, it's planning, but it sets the tone for your audit. Also, it is the basis from which your opinion flows, right? You have to be able to support your opinion based on the audit evidence that you collect. Just again, to drive this home, preliminary and final review, analytical procedures are required. Substantive testing, it's optional. So let's do a short problem. Okay, so let's regroup and talk about this. So what kind of company is Majestic? That's a trick question. What kind of company is Majestic? Oh, wow. Really? Okay. So it's a hotel. So what kinds of things come to your mind about that industry? What customer service, what else? Amenities, what else? Laundry. So how do those things factor into your analysis of the information presented, the financials? So what do you have? You have the Majestic's performance in relation to the industry. So what are some of the things that jumped out at you looking at that? Yes, Amal.
Everything about the food and beverage was very different compared to the industry. And then the rooming costs.
Management fee. So let's stick with the room and beverage the food and beverage, I'm sorry. The food and beverage. What, you said everything about the food and beverage. What?
Anytime I saw the food and beverage, we put a star next to it because it was very different, whether high or low, but it was just very different compared to the industry.
And so what did that raise for you? What kind of potential problems did you see?
They're not controlling their food and beverage costs.
So maybe they might not be controlling the food and beverage costs that jumped out. Anybody else? Yes.
The biggest thing I noticed is that the room rate is a lot higher, higher than the industries.
The higher room rate than, and what impact could that have?
It shows the need that there are way more rooms available.
So maybe they're outpricing themselves in the market, which could mean how long can they sustain that cost, that structure? I saw, Isaac, did you say? About what?
It all depends how many customers you have. If you don't have customers, I don't think maybe you're using it. If you have more customers, that's what you use it.
Rooms or food and beverage?
Yes.
Not necessarily. Well, yeah, of course you need customers to sell to.
Then that tells you why the figures are up and down.
Right, but you don't know, right? But still, so what would it suggest to you if they're not generating customers? What does that suggest to you about?
Sometimes they're having more customers, sometimes they're having less customers.
Right, but what's the impact of that? Right, but
200 rooms available compared to the industry was one.
right.
When you have 200 rooms, it doesn't mean that every day you have to put some.
Right, but this is percentages, right? So you're looking at their percentage of occupancy over the year as compared to the industry, right? So over that would take into account fluctuations. But what does it suggest to you if their occupancy rate is so low? Right, that they're not having more customers. What's the financial implications of that? Well, that could be one, but what's the financial implication of not having customers? Profit is lower, and if your profit is lower, you're not a successful company. What could happen if you're not successful? You could go bankrupt. There might be going concern issues, right? Right, so that's what you're looking at. If they're not, because how long are they going to be able, obviously you have 1 year of data, but if you're the auditors and you're seeing this, there could be concerns about their profitability and their ability to sustain as continue operations. Yes. Sorry.
What were the numbers based
Right. So that's a very good point. That's looking at the relationships, right? So their numbers are lagging, yet their management fees are high. Why? If their numbers are lagging and they're not generating enough business, why are their management fees so high? That would raise questions. So looking at the relationship doesn't seem to make sense.
And that year they hired more managers
But why? Well, there could be.
to improve the quality.
So they hired more managers to try to go out and get more business. So you'd want to look at when they hired.
But then, if they hired more managers, then why didn't they control it enough for the profit for food and beverage to be, more matching? Like it's 4 to 15. They're not even in double digits.
Yeah, but then we have to wait for the next year's to see the hiring more managers.
But at least, like, they're so
If you're
low.
hiring, also if you're hiring more managers, then the engineering is more expensive. So why would you do that when you're already in cost? You know. So why would you hire more people when you're not?
But right, but these would be questions that would raise. So one of the things that we do, that you're required to do as a part of the audit process, is called brainstorming, especially in SAS 99 fraud brainstorming, and that's the kind of conversations that you would have, like, well, maybe it's this. Obviously, a lot of your questions are driven by the fact that you only have 1 year of information and that's it. You know nothing else about this client. But you would expect to see, if they hired, in your explanation, if they hired a management company to try to boost their revenues, that's something you might see in the board of directors, or that minutes, or the board meeting, or something that you would see in their strategy or their objectives, their sales projections, that this is how they're trying to drum up more business, so they're going to go out and hire a management company. I saw my hand. Salaries and wages. Right. So again, they seem to be outpacing the industry in food and beverage, salaries. So you wonder, why are they so much higher? Are there concerns with payroll? What's one of the things that you might think of in this industry with respect to payroll? Overstaff, or you could, there's overpaid. But what if you were thinking fraudulent activities, what might come to mind for this industry?
Start to come up figures so that they can get more, maybe they pay the commissions.
Padding, right? Padding the payroll or something like that. Phantom employees, maybe? Yes, sir.
Maybe they're paying a lot of people under the table.
Right. They could be paying people under the table, or misclassification of expenses, right? So you don't know. So there are enough anomalies in the data that, in comparing just within their own data, and then anomalies comparing their data against industry, to suggest that there might be some potential problems, right? That you, from an audit in your planning process, would look, it's attention directing. Yes?
What would happen in case that the external auditor actually finds something and they actually don't have the documents and prove that something is not going right? It's costing the companies more expensive.
Okay, so you have multiple.
Would you consult their CFOs?
Right. So if it's something, if you say something's not going right, if you're talking fraud, then the auditor has to communicate this, that they suspect fraud, to management and to the corporate governance, audit committee, right? Because they're charged with the oversight of financial statements. So they have to report that to management. Now, it's not the auditor's responsibility, right, to find the fraud and then go. But they are now, management has to have a response to that when the auditors bring it to their attention. They have to know how management is going to resolve this issue that impacts, right? If you're talking about just general operating, where, we notice that they're, you're outpacing the industry in terms of what you're charging for food and beverage. That's more operational, you have, or if you notice that their internal controls are not effective, but not to the point where you would qualify the audit opinion, but that they could be more efficient in some areas. That's what we call a management letter, where the auditors make, based on their observations, they can make recommendations. That's called a management letter about the efficiency and
In the
effectiveness.
case of fraud, you said you have to tell the management, right?
Yes, you have to bring it
The manager
immediately.
is involved.
Well, if you think the CFO, you have a responsibility to the board of directors, right? Because they hire you, so you go to the audit committee.
Do you go
If you think it's the CFO, you're not going to tell the CFO, right?
Exactly.
So you go to the audit committee. The audit committee is not involved in day-to-day operations, and they have oversight. So you would bring it to the board of directors through the audit committee. Isaac, did you have your hand up?
So what, you don't have any specific analytical procedures, like you guys have analytical procedures, right?
No. I'm going to answer the question.
So because I'm seeing everybody has its own opinion, so.
Well, right. But that's part of forming an expectation, right? I mean, clearly, if this was a real audit, you'd have a lot more information. So your expectations would be better informed. You'd have more information to form an expectation, right? Right now, you just have a case in front of you, a problem, and you're throwing out ideas about what it could be based on your analysis of the relationships within the account, between different accounts, and the relationship to industry. Right? But in an audit, a real audit, you would have more information to form those expectations, and then you would follow through. So you would think of, okay, what is a possible reason for this fluctuation or this change, right? What's the possible reason that their management fees are so much higher? And then you would, your audit procedures would be to look at management fees. You might want to look to rule out that there are no related party transactions, right? Because if it's related party transactions, those fees, so for example, it's a hotel. A lot of hotels, especially have their own management company, right? So they have companies that they have go out and market the hotel, go and get, try to get a book guests, right? So if that's a related company, maybe those fees have not been reclassified, right? They should be eliminated in consolidation, so they shouldn't be in there. So that could possibly be an accounting error. So your audit procedures would be looking to see what the possible causes of that would be, right? So you would look at management fees in more detail in terms of your audit procedures. So you wouldn't do analytical procedures to see if if management fees made sense, because you just performed preliminary analytical procedures. You saw that there was this huge discrepancy. So now you'd want to look at documentation about management fees to support that number to make sure that there are no problems. Someone's hand was up, I think. No? Okay. So obviously it's a large hotel. And another thing is, in doing what we don't know here and what we can assume, but we don't know for sure, it's not enough to just compare in a case like this, right? You can't just say, I'm going to compare it to the hotel industry. Why? What's unique about, well, maybe not unique, but what's one characteristic of the hotel industry? Everyone is different, and what? Right, level of service, but, right, so you have the Plaza, and you have Holiday Inn Express. Would you compare Holiday Inn Express to the Plaza? No, right? So you would want to make sure that your industry comparison is that you're comparing hotels in the same industry group, right, or in the same tier level. Thank you, in the same tier level, right? Because otherwise those numbers would be skewed. So it's not enough to just compare it to the overall industry. Right. Okay. So we don't know that, but we're going to assume that that's what the auditor did. So I pointed out 200 rooms versus 148. So they're somewhat larger than the industry that they're being compared to. Their charges slightly more than average rate, 160 versus 120. So, you know, are they overcharging for the market? Are they providing services that their competitors are not providing? We don't know. They don't seem to promote room occupancy too heavily, 2.7 versus 3.2. So now this could be that they have their own management company, so they're not spending as much money on outside advertising. So you need to know what's in that advertising number. Their paying guests, so their occupancy is not very high, 62 versus 68. Their occupancy rate represents more average rooms per day, 125 versus versus 101 for industry. They derive more revenue from food and beverages. So they're roughly 36%, the industry is 32%. They seem to be more lavish in providing food and beverages. So you see that the cost of food is much higher and the cost of beverages sold much higher. Wages are also much higher than industry. So what you'd probably want to look at is, again, do they have a change in strategy perhaps? Maybe they're trying to move up from the Holiday Inn Express level to maybe more the Marriott Residence Inn. I don't know. Right? So maybe they're trying to move up. So in trying to move up, they're improving their banquet facilities. Maybe they're trying to get more money, or more revenue from banquets and from banquet services. So as a result, they're increasing the quality of service that they provide. Right? So again, that's something, if we knew or had information about their objectives and their strategies, their goal, their short-term goals in terms of the business or the mix of revenues, then we would be able to evaluate that a little bit more so than we can now. So, but right now we just have raw changes in the numbers, so you'd want to look to ensure that they're not somehow misclassifying expenses or revenue. So given those the differences between Majestic and the industry, some of the things that we would look at to determine whether or not there's some audit issues or potential errors. So since room sales revenue is not up to the industry average ratio, revenues may not be recorded properly. Right? So we would look, one, when we're testing internal controls, we would look at the controls around the recording of sales. We want to make sure that they're not misclassified. So how are sales posted? What are the controls over posting to the correct general ledger accounts? Management fees also are much higher than industry average, as was pointed out. Is it possible that they misclassified expenses? So it's not that management fees really that high, or are there related party transactions that may be involved? And if they're related party transactions, obviously when you consolidate, those expenses should not be there, right? You should eliminate those expenses in consolidation. Utilities, repairs, and maintenance appear to be higher than industry average. You want to make sure then that expenditures could have been incorrectly, maybe they should have been capitalized, and they misclassified them as operating expenses. So you want to look at that when you're auditing to ensure that items that should be capitalized are indeed capitalized. We also show that salaries and wages in both the rooms department and food and beverages department appear to be high. The problem may be more employees than average, right? That they just have a lot more employees. Could be padded payrolls, which would be fraudulent activities, or their wage rates are simply higher than average. Right? But again, so that we would want to look at the sales, salaries expense in the cost of our audit. The cost of food and beverages, again, higher than industry average. Again, could it be higher quality? It's just that they're getting buying a higher quality food, as I talked about. Are they trying to, change their direction, generate more revenues from food and beverages? So as a result, they've changed their product mix. We don't know. Again, the objective of this problem obviously was, here you are as an auditor in the preliminary planning phases. So you're just trying to determine, okay, where might there be potential problems? And so analytical procedures are a good way to be able to do that, which is why be able to identify where potential problems are. They're not saying that, oh yeah, there's a fraud going on, but it's just directing the auditor attention to those areas where relationships might not make sense, whether it's relationships within the company's financial accounts or relationships as compared to industry, where something just seems not to jive with your expectations about that account based on your understanding of the company's environment, the company, industry, economy, things like that, right? So that's the looking at the outcome of those procedures, those analytical procedures against your expectations that you formed as a result of the understanding the company's business. Okay. All right.
So of this review, we can see that in the preliminary analytical procedure stage, the auditors need to get better understanding of the client and its industry. Also, the auditors need to perform some basic or preliminary analytics to the client's data. Even though that auditors can use many different analytic methods in this stage, such as the descriptive statistics and the other basic analytics that we have discussed in previous lectures, ratio analysis is also another analytic method that auditors can use in the preliminary analytical procedure. So the ratio analysis involves methods of calculating and interpreting financial ratios to analyze and monitor the firm's performance. Some auditors can use these ratios to facilitate the formalization of the audit opinion. Besides auditors, also there are some other parties that are interested in the financial ratios, such as the current and the prospective shareholders. They are interested in the firm's current and the future level of risk and return, which will directly affect the share price. And creditors are interested in the short-term liquidity of the company and its ability to make interest and principal payments. Also, management is concerned with all aspects of the firm's financial situation and its attempts to produce financial ratios that will be considered favorable by both owners and creditors. Basically, there are several types of ratio comparisons. The first type is the cross-sectional analysis. It is the comparison of different firms' financial ratios at the same point in time. Or there are two kinds of cross-sectional analysis. One most commonly used cross-sectional analysis is the benchmarking. In benchmarking, the firm's ratio values are compared to those of a key competitor or group of competitors that it wishes to emulate. And also, the comparison to industry average is a popular type of cross-sectional analysis. This slide shows some example of the comparison with the industry average. We can see that the Caldwell Manufacturing calculated inventory turnover as 40.8, while the industry average in 2012 is 9.7. So there is a significant gap between the well, manufacturing, inventory turnover, and industry average. So the auditors need to figure out why this gap exists. Also, this slide shows an example of the financial ratios for select firms and their industry media venues. We can see that for Dell and HP, there is current ratio. So the comparison of Dell and HP's ratios is the benchmarking, and the comparison of Dell and HP's ratios to the average computers companies ratios is the comparison to the industry average. Also, we can see the benchmarking also between Home Depot and Lowe's, the Kroger and Whole Foods Market, the Sears and Walmart. And also these companies, they compare their ratios to the industry average, like the Home Depot and Lowe's to the building materials, the Kroger and Whole Food Market to the grocery stores, and the Sears and Walmart to the merchandise stores. Another type of ratio comparison is the time series analysis. It is the evaluation of the firm's financial performance over time using financial ratio analysis. It compares the current ratios to the past performance. This comparison enables the analysts to assess the firm's progress, and also it could develop trends that can be seen by using multi-year comparisons. Usually the most informative approach to ratio analysis combines the cross-sectional and time series analysis. This figure shows an example of this combined analysis. So we can see that the company called Bartlett, it compares the ratios across the year 2009, 2010, 2011, and 2012. So this is the time series analysis. And also it compares its ratio to the industry average. So we can see that this orange line is the ratio of bachelors, and this blue line is the ratio of the industry average. So this is a cross-sectional analysis. So when we combine the cross-sectional and time series analysis to create this combined view, it gives the analysts more information. When we're using the financial ratios, there are few things that we have to consider. The first one is that the ratios that reveal large deviations from the norm only indicate the possibility of a problem, not necessarily a problem. And second, a single ratio doesn't generally provide sufficient information from which to judge the overall performance of the firm. So during the analysis, maybe it's better to consider a few ratios together. And the third one is that the ratios being compared should be calculated using financial statements dated at the same point in time during the year. The fourth point is that the financial data being compared should have been developed in the same way. Otherwise, the result is meaningless. Also, the results can be distorted by inflation. Then we're going to use example that's from the Bartlett company to specify the calculation of several different ratios. Now here this is the income statement of Bartlett, and this is the balance sheet of Bartlett's company. We're going to use numbers in these two financial statements to calculate the commonly used financial ratios. Okay, the first group of the financial ratios is called liquidity ratios. And the first ratio in this group is called current ratio. It's equals to the current assets divided by the current liabilities. Now let's go back to the balance sheet of the Bartlett company. We can see that the current assets of Bartlett company is equal to $1,223,000, and the current liabilities is in next slide is equals to the, we can see that here total current liabilities is equals to 620,000. So when we calculate the liquidity ratios, we just need to use 1,223,000 divided by 620,000. It's equals to 1.97. And the second ratio in the liquidity ratios group is called quick ratio. It's equals to the current assets minus inventory divided by the current liabilities. Still go back to the Bartlett company's balance sheet. You can see that the inventory here is 289,000. So we just need to use the total current assets, $1,223 minus the $289,000, and then divide it by the $620,000, which is equals to 1.51. Okay, so we can see that these two different ratios indicate the importance of inventories. According to the table, this table, we can see that the current ratio of Dell is 1.3, and the current ratio for Home Depot is 1.32, also for the Lewis. But the quick ratio for Dell is 1.2, while for Home Depot and Lewis, the quick ratio is very much lower than the current ratio. So why the quick ratios for Dell is very close to its current ratio? As we all know that Dell is very famous for its just-in-time operation style, so it has very low inventory rates, which makes its quick ratio very high and very close to the current ratio. So with the company with less inventories have the higher quick ratio, which indicate better liquidity. Okay. Then another group of ratios is the activity ratios. And the first ratio in this group is called inventory turnover. It's equals to the cost of goods sold divided by the inventory. And when we go to the example, we can see that in the income statements, the cost of goods sold is equals to 2,088,000. So we just use this number divided by the inventory, 289,000. The result is 7.2. And the second activity ratio is average age of inventory, which equals to 365 divided by the inventory turnover. So for the Bartlett company, we just need to use 365 divided by the inventory turnover that we have calculated. In last slide is equals to 7.2. Then we got the average age of inventory equals to 50.7 days. Another activity ratio is average collection period, which equals to the accounts receivable divided by the average sales per day. Average sales per day is equals to the annual sales divided by the 365 days. In this case, we first calculate the average sales per day. First, we find the annual sales in the income statement, which equals to $3,074,000. Then we divide it by 365 to get the average sales per day, which equals to 8,422. Then we use accounts receivable, which equals to $503,000 divided by this. 8,422 to get the average collection period, which equals to 59.7 days. Average payment period is another activity ratio, which equals to the accounts payable divided by the average purchases per day. And the average purchases per day is equals to the annual purchases divided by 365 days. In the two statements of Bartlett company, we don't know the annual purchases, but if we assume that the Bartlett company's purchases equal 70% of its cost of goods sold in 2012, then we can get the average payment period. First, let's calculate the annual purchases. Because we assume that the annual purchase is equal to 70% of the cost of goods sold. So let's first find the cost of goods sold here in the income statement. It's equals to $2,088,000. Then we multiply 0.7 and divide by 365 to get the average purchases per day as equals to $4,004. Then we use accounts payable here equals to $382,000 divided by the $4,004 to get the average payment period, which equals to 95.4 days. Another activity ratio is the total assets turnover, which equals to the sales divided by the total assets. Let's go back to the case. You can see that the total sales is the sales revenue equals to $3,074,000. Then we divide by the total assets. Here is $3,597,000 to get the total asset turnover, which equals to 0.85. Then we go to another group of ratios. It's called debt ratios. The debt ratio is one ratio in the debt ratios, which equals to total liabilities divided by the total assets. So in the case, we can see that the total liability for Bartlett company is here total liabilities equals to $1,643,000, and then we use it to divide it by the total assets, which is $3,597,000 to get the debt ratio equals to 45.7%. Another debt ratio is times interest earned ratio. Is equals to the earnings before interest and taxes divided by taxes. So also let's go back to the income statement of Bartlett company first. Its earnings before interest and tax. We can find it's also called operating profits. Here is $418,000. Then we divide it by the taxes, which is $94,000. Then we get the times interest earned ratio equals to 4.5. Another debt ratio is fixed payment coverage ratio. Compared to the other ratios, the calculation of this one is a little bit complicated. It equals to the earnings before interest and tax plus the lease payment, then divided by the interest plus lease payments, then plus the sum of principal payments plus preferred stock divided preferred stock dividends multiple 1 divided by 1 1 minus tax rate. Then we go back to the Bartlett company's data. First, let's calculate the tax rate here. In the income statement, the calculation of tax rate is using the tax number divided by the profit before tax to get the tax rate equals to 0.29. And then we use earnings before interest and tax, which is $418,000 plus the lease payment. Let me see, the lease expense equals to $35,000. Then we divide it by the interest is $93,000 $35,000 plus lease payment again. It's equals to $35,000. Then we can find the principal payments in the balance sheet here in the footnote. The annual principal payments on a portion of the firm's total outstanding debt account amount is $71,000. And then we plus the preferred stock dividends. It's here. The annual preferred stock dividend is a total of 10,000. Then we use this number plus the preferred stock dividends. We can find it here. The annual preferred stock dividend is in total $10,000. So after this calculation, we get the fixed payment coverage ratio is 1.9. Then another profitability ratio is called gross profit margin, which equals to the sales minus cost of goods sold divided by sales. Also, we can say it's gross profits divided by sales. Then let's go back to the statement. Find that the annual sale is equals to $3,074,000. Then we minus to the cost of goods sold, $2,088,000. Then we divide it by the sales again, $3,074,000 to get the result equals to 32.1%. Another profitability ratio is called operating profit margin. It's just use the operating profit divided by sales. Okay, let's find the operating profit. Here we can find that it's equals to $418,000. Just use this number divided by the sales revenue to get the result equals to 13.6%. Then let's calculate the net profit margin. It's equals to the earnings available for common stakeholders divided by the sales. In the example data, we can find an earnings available for common stockholders. Here is equals to $221,000. Then we just divide it by the sales revenue to get the result equals to 7.2%. Another profitability ratio is earnings per share. It's equals to the earnings available for common stockholders divided by the number of shares of common stock outstanding. Let's go back again. Since we already find the earnings available for common stakeholders is equals to $221,000, well, we can find the number of shares of common stock outstanding in the balance sheet here. The common stock, the shares issued out and outstanding in 2012 is 76 is 76,262. So after this calculation, we got the result is $2.9. Return on total assets, ROA, is another profitability ratio. It equals to the earnings available for common stakeholders divided by the total assets. In the Bartlett example, we can see the earnings available for common stakeholders here, and then we just divided it by the common stock equity. But what is common stock equity? In the balance sheet, we can find the total stakeholders equity is equal to $1,954,000, while we can also find the preferred stock is equal to 200. So we just use the total stakeholders equity minus the preferred stock to get the common stock equity, which equals to $1,754,000. Then we can get the result of return on equity equals to 12.6%. Finally, another group of ratio analysis is the market ratios. The first ratio in the market ratios group is called price earnings ratio. It's equals to market price per share of common stock divided by the earnings per share. As we have already calculated before, the earnings per share is equals to $2.9. If we assume that the Bartlett company's common stock at the end of 2012 was selling at $32.25, then we can calculate the price earnings ratio using $32.25 divided by $2.90. Then we got the result equals to 11.1. Another market ratio is the market book ratio. It's equals to the market price per share of common stock divided by the book value per share of common stock, while the book value per share of common stock equals to the common stock equity divided by the number of shares of common stock outstanding. Then let's go back to the case. First, we need to calculate the book value per share of common stock. As we already calculated that the common stock equity equals to $1,754,000, then we just use it to divide it by the number of shares of common stock outstanding, which equals to the 76,262. Then we get the book value per share of common stock equals to $23. If we still assume that the company's end of 2012 common stock price is $32.25, then we use it to divide by the book value per share of common stock, which is $23. Then we got the market book ratio equals to 1.4. Okay, now we have introduced all the commonly used ratios for financial statement. Here is a summarization of these ratios using the example data. Okay. Then we're going to see part of Helen Brown's class again, which is using a case to demonstrate how to use this or some of these ratios in the preliminary analytic procedure.
Okay, so obviously you knew that this portion of the case was the engagement planning part of it. And so part of what the auditor's responsibility is with engagement planning is to be able to identify, get to understand what the client issues are that could impact the current year audit. So as a part of that, you had to identify issues by going through the board of director minutes and thinking about how that would impact the audit. And then also doing, analytical procedures, looking at the changes from last year's audited financial statements numbers to the current year numbers, looking at a comparison of the company's performance as compared to those companies that are their competitors, such as Nike. And then also doing some ratio analysis. And the objective, again, is to identify, remember, analytical procedures in the planning stage is directing attention, attention directing, to get auditors to kind of focus on where might there be problems, and then given those issues, potential issues, how do we address those issues in developing our audit approach. So let's start with, okay. So in this case, you had financial information. If you looked at the 10K, you actually had financial information, audited financial information for 2 years, 2009 and 2010, and you also had the unaudited information for 2011. And so what we're trying to do, as I pointed out, is compare the balances for 1 year against the other. So a year-to-year comparison to indicate if there's any changes that jumps out at the auditors to indicate that there might be a potential problem. It also involves looking at what kinds of unexpected relationships seem to develop, right? So analytical procedures, again, you look at year to year, but within the accounts, you would look at information with respect to relationships. So for example, we know in the revenue cycle, there are relationships between accounts. So what are some of the relationships that we expect to see in the revenue cycle, starting with sales? What other accounts are going to be impacted? Accounts receivable. Andrew?
Cost of goods sold.
Cost of goods sold in what way?
So if you sell more, then your cost should also go up as well because you're going to buy more supplies or more inventory.
Right. So through cost of goods sold through inventory, right? So, right, because as Andrew pointed out, if you're seeing an increase in sales, you would expect that there's an increase in the purchase of inventory and the sale, obviously, of that inventory. Yes.
Net income.
Net income obviously would be impacted, right? If you have increased sales, then you would expect to see that your net income will probably increase. And if you don't, right, then you would look for reasons why. So again, in looking at changes from year to year, you're also looking at changes in relationships. So if we see sales increase, there's some expectations that we would have about accounts that are impacted by that. So we would look to see that those relationships make sense, that they're moving in the right direction. And a part of this process is obviously, remember, we conduct a risk-based audit. So auditors want to be able to identify where the risks are in the financial statements and develop the audit specific audit procedures to address that risk. So here's just an excerpt from the Apollo trial balance, right? And part of your requirements was to take the trial balance and break it down into common size financial statements, but also just to start to group those accounts that would appear as assets in the financial statements, liabilities, and owner's equity, and then those accounts that would appear as sales and expenses in the income statement. So this is just taking the assets, the total assets for Apollo. Right? And so here we have audited financials, right? So at least at this point, we know that those numbers have been reviewed by some independent person, the former auditors, right? And so what we're seeing, I've highlighted a couple of the issues that would jump out from an auditor. So just based on pure eyeballing the account, and the trial balance and looking at the information there, you can see accounts receivable has increased dramatically, right? So it's gone from 16 million to 49, almost $50 million in the current year, right? What did you note in the notes to the minutes, the board of director minutes, that might give you pause about that number, that might raise a red flag? From the board of director minutes, it was the very first minutes that you read. For accounts receivable. It went up $50 million. There were indications in the board of director minutes that should have made you zero in on that increase. Should have raised a flag for you. I think it was the 6:30, 11 minutes. No one remembers? Weren't they having problems with sales? What did Lancaster said? A number you raised it as a red flag. Yes, Sammy.
He said that if sales don't go up, heads will roll.
Right. So that tells you that there were a problem with sales. So either sales are pretty stagnant or they're going in the wrong direction. So if that's the case, why would accounts receivable be up by, from 16 million to $50 million, right? So given that information that you received by reviewing the board of director minutes, this number should have jumped out. Even if the sheer magnitude of the increase didn't concern you or make you wonder, the fact that in the board of director minutes they told you that there are problems here. They're not selling. Another factor in the board of director minutes was that they increased their prices by 10% because they weren't selling to meet expectations, that they increased the prices. 10% increase in sales is not going to amount to this much of an increase in accounts receivable. So what's another likely scenario? If accounts receivable is going up and sales is not rising, what does that suggest to you? Yes?
Lower the standards for giving clients credit.
Right, so there could be a credit granting problem, right? An internal controls issue, right? They might just be trying to sell to anyone, and so what does that create for the company from a financial perspective? Yes, it's an internal control weakness, but what does it create from a financial perspective?
Liquidity, it's not, they're done.
Well, they're not collecting, right? So if they're not collecting, they're not generating cash. So how do we account for uncollectible accounts in our financial statements? Allowance for doubtful accounts. So therefore, we would expect to see some kind of change in allowance for doubtful accounts, but yet there's no in fact, allowance for doubtful accounts went down. The relationships don't make sense. Accounts receivable has gone way up. Sales are stagnant, right, or going in the wrong direction, and the allowance hasn't moved. So right there, that's a risk. That's a risk of a material misstatement, that there could be a problem with the allowance, right? Then you'll see inventory. What did we say? Sales are not moving, but inventory went from $18.8 million to $67.4 million. Then we see the reserve goes down from $3 million to less than $1 million. So there are tons of, just on the asset side of this company alone, we see all of these relationships that don't seem to make sense. We see that prepaid insurance went up substantially to $3.3 million, right? So we would want to look at that. Then looking at property, plant, and equipment, or specifically machinery, equipment, and office furniture, we see that that went up to about $2.9 million from under $500,000. But we know from the board of director minutes that they purchased machinery and equipment. So you would expect to see an increase in the machinery and equipment account, as well as an increase in the accumulated depreciation associated with that, right? So just based on your pure just scanning the numbers, you know that there are problems, and then you have to, you know that there are things that raise a potential issue, right? Just based on the changes in the numbers, and then you have to think through, utilize what you've learned from the board of director minutes and other pieces of information that you gather as a part of understanding the business and what's going on, to try to make sense of that, to form your expectations. Because remember, what we said about accounts receivable is that auditors use accounts receivable, they're going to form an expectation about what the relationship should be, what direction the change should be in order to determine whether or not it makes sense, right? Whether or not there is a potential risk. And so if you think about it, when you started the first thing you had to do was read the board of director minutes. That provided you with information about what was going on in the company to help you form your expectations about the numbers that appear, the unaudited numbers. So then again, net sales, I highlighted the whole thing, right? So here we see that sales actually decreased slightly, right? But so more or less it's pretty stagnant, as I pointed out before. What we see though is net sales has gone down by about $10 million. Net sales returns and allowances went from 4.4 million, 4.5 million to 13.6 million. That's huge, right? Why do you think sales returns and allowances might go up so dramatically? What is a legitimate business reason, and what is a possible fraud, management fraud, reason driven by management fraud? When you see sales returns, yes.
Legitimate reason, maybe like a recall.
Right? Exactly. What in the board of director minutes did you see that suggests that there might be that is possible? Okay. But now, can I use this minute as a teachable moment? As an audit team, you need to know what's going on, right? Remember, we brainstormed, that whole brainstorming part of it, to identify where the fraudulent issues might be, right? Where fraud might occur. Management fraud is a fraud. So it's important to kind of get into the habit of knowing what your team members are doing and where because you need to know how that might impact the areas that you're doing. Just an audit teachable moment. Someone else had their hand up, right? So we had recall, possible.
If I recall correctly, the pending lawsuit that they were hoping would be resolved.
Right, the negligence, which could be, right, associated with this, that they have bad product out there, again, associated with the recall. So those might be legitimate business reasons. What might be a fraudulent management fraud? Yes.
Can it be that they're putting in fraudulent returns to take out cash or something? I'm trying to think of fraud.
Well, so if you have a sales return, what's your journal entry?
You're gonna debit the asset for the return. You're gonna credit cash or credit stuff or sales. I don't know.
Was it sold on credit or was it sold?
Right. So the sales return account, you're not going to, you never directly debit sales, right? You record that in sales return. So here's a potential problem. That might be an indication of fraud, channel stuffing. And so what happens is in this period, maybe these sales are overstated. Maybe they were just stuffing the market or flooding the market with their products. Right? And so maybe they had a side agreement. We don't know. But that 13 million is a red flag. Right? So what if they had a side agreement with their customers, the salespeople, because we already know that Lancaster said heads will roll. Now keep in mind, this was as of the 6/30. So this is interim. So auditors got the board of director minutes and they see, as of interim, he's putting pressure on the salespeople to sell. Right? So if salespeople are saying, look, let's just get the product out there, we'll tell our customers, you could send it back to us at year end. We'll take returns with no problem. Which means that the sales in 2010 were overstated, right? Because they had this side agreement. So if you have a side agreement, the earnings process is not complete, right? Because you're basically just saying to your customers, take this so we can boost our numbers and we'll take it back. That could have happened. We don't know. We're going to have to look at internal controls. What an audit step, and we'll talk about this when we talk about the revenue cycle more, is what you're going to look at returns a few days before year end and a few days after year end. Because what you want to see is whether or not you're going to look at these sales to see if they really relate to returns from the previous year. So what portion of that 13.6 million is really from 2010 sales, right? Or also, what are they, doing this on a quarterly basis, just shipping stuff out there, trying to boost their quarterly numbers so that they're trying to set market expectation, and in reality, they're not going to get those, they're going to, it's not truly a sale. Customers are going to return those goods, right? So that could be channel stuffing is a way of trying to artificially boost your sales numbers. Right? So that again, the auditor would be concerned about. All right. So then again, so with sales returns, we see net sales decrease by 10 million, mostly because of these returns. Yet, given the board of director minutes we saw in 1/5/11, management was suggesting that sales would increase by 10%, right? They expected them to increase rather. Also, as I pointed out earlier, Apollo raised those prices by 10% to meet expectations, and you're not seeing it because this is a huge number that's driving down net sales, right? So that's a huge. Anytime you see something like this, 229%. So when you're setting up your substantive audit procedures, right, for revenue, one of the things you have to have is, in terms of your audit procedures, is to test this sales number, right? You're going to have to look, there has to be procedures that you perform to look at sales returns and allowances, right, because that number increased significantly. So that increases your risk. Okay, so that's sales. Other things that you'd want to look at is analytical procedures, looking at, as I pointed out, we saw that accounts receivable increase. So it increased by 203%. What are some of the audit procedures you think you would perform? Confirmations, right? So you want to confirm those accounts. But before you even go there, you want to know about internal controls. So you want to ensure, so that's the second part of your project that is due, is looking at internal controls over the revenue process. Remember, the revenue cycle includes both income statement accounts in the form of sales, net sales, returns and sales returns and allowances, right, as well as balance sheet accounts impacted by that, cash and accounts receivable and the allowance for doubtful accounts. And in all of those accounts, you have concerns, right? You have concerns about this 203% increase. It doesn't make sense, especially given the fact that the allowance is not increasing. What else did we see? And what did we see in the minutes related to the allowance or accounts receivable? All of you raised it as an issue, so clearly you thought it was an issue, I hope. Did they write off any receivables? Do you remember? I hope your memory was better on the exam. Did they write off any receivables? Yes. Right. They wrote off one receivable. Would you consider it $8,000 to be significant given the size? Would that be material? No. Right? But all of you raised it, thank God. Right? All of you raised it, and I hope you raised it not because you thought it was material, but the question was, well, what else should be written off? I hope you raised it because you recognize that this relationship didn't make sense. That the allowance, Apollo's accounts receivable increased by 200%, yet the allowance did not move. They wrote off one account. The other thing that should have grabbed your attention from the minutes was the fact that the Lancaster we're not writing off anything else. And that should give you pause and concern again, because you saw this increase, and the increase doesn't make sense given net sales, right? So your question when you raised that $8,000, yes, it's immaterial, but qualitatively, it's not. Qualitatively, it's material because of management's attitude about writing off receivables or adjusting the allowance for doubtful accounts, given what we see on the financial statements with the trend in accounts receivable and in sales. There's no bad debt expense, right? Yes.
So management decides qualitative, but they do.
No, management can't decide anything about materiality. Auditors determine materiality. That's an audit judgment.
Okay, so I understood it was audit judgment for the actual like nominal amount, but then for the for like the example you just gave, what did you say about management that they would
Manage what I said. Okay, first of all, let's clarify. Materiality is an audit concept. Management has absolutely nothing to do with the auditor's materiality or what the auditors consider material.
Okay.
Pure audit judgment.
Yeah.
Okay, so what I said was quantitatively, $8,000 is immaterial,
Yeah.
right? There's no way you're going to argue with this balance sheet, as inflated as it might be, that $8,000 is not is material. What makes this issue material, right, is the fact of management's attitude about writing off receivables, right, and the fact that it involves an estimate. And we know, or we suspect, that there are problems with this estimate called allowance for doubtful accounts, right? Because receivables have increased, sales are not decreasing, sales are not increasing in the same direction, but yet they've only written off one account. So that's what makes it qualitatively material. The other thing is that day sales and accounts receivable. So calculating a ratio. Remember, analytical procedures includes ratios. So if we look at day sales and accounts receivable, it increased from 25 days to 79 days. That should tell you that they're not selling. They're not turning they're not collecting. They're not turning their receivables over. So you would expect to see, if that's the case, that's proof that there's a problem with the allowance for doubtful accounts. Because in your audit procedures, your substantive audit procedures, you need to have audit procedures that examines the allowance for doubtful accounts. Right? So you would want to challenge what management has there, right? If that is an appropriate amount. The fact that this hasn't gone up and there's no bad debt expense should tell you that there's probably going to be an audit recommendation or proposed adjustment to increase the allowance for doubtful accounts. So we would see that bad debt expense would increase and the allowance for doubtful accounts would increase. As I pointed out, day sales and accounts receivable suggest that they're not collecting on credit sales. The allowance for doubtful accounts is possibly and probably highly probable that the allowance for doubtful accounts is understated, and because they're not collecting. We see that. They're going from 20-something days to almost 80 days. And as a result of that, if we're addressing the valuation assertion, then accounts receivable is probably overstated. It's not stated correctly. So FYI, as you're developing your substantive audit procedures and you're trying to decide, so again, when I looked at the audit procedures that you included, some of you were extremely detailed. You just threw everything you could find about accounts receivable, about different audit procedures for each of the areas in there. You have to tailor those audit procedures to Apollo. Okay, so you have to decide which are the way to approach that is think about you have to address it from the assertions, right? Remember, the assertions establish the framework. So what procedure, audit procedure, given Apollo's environment, their controls, are going to best address the assertions, and that's how you decide what procedures you should include. Okay. So we know to be able to address this, we're going to have to look. The valuation assertion is we're going to have to confirm accounts receivable, but also we're going to have to look at the allowance and see, perhaps propose an adjustment to the allowance account to make sure that the allowance account is reflective of their true economic environment for Apollo. I talked about this already. Lancaster authorizes the write-off of one, but refuses to do any more, right? So now if you're thinking about the control environment, what does that say about management? What does that suggest? That suggests that they have this kind of, that's management integrity. So what part of the audit risk model is affected by this Lancaster statement? Not by his statement. So if not controls, then what? Inherent risk, right? Management integrity goes to inherent risk. There's a lot of pressure here that management places on people, on their employees to move numbers, to make numbers, right? So that increases your inherent risk. I also pointed out that inventories, we saw that inventories increased significantly, right? However, we didn't see any increase in sales. So what are you doing? Stockpiling inventory? What would be the point of having all of that inventory, right? If you're not selling it, why are you increasing it? The other thing is, if I didn't show the liability section, but accounts payable decreased by a significant amount. So your inventory is up by this humongous amount, and then your accounts payable is down. So how are you paying? Right? If you're not collecting, where are you getting the cash to pay? Right? So again, we did see, kind of going to liabilities for a second, that they took, from the minutes, we know that they drew down on debt, right, on their line of credit. So maybe that's how they're financing. We don't know, but that bears more discussion, more evidence gathering from the auditors. The obsolescence reserve did not increase in relation to the huge increase in receivable. In fact, the obsolescence reserve decreased by 71%. So, and then we see, though, that doesn't make sense, that relationship doesn't make sense given the fact that when we compute the day sales and inventory, we see that inventory goes from 49 days to 189 days. Right? Those are huge red flags of potential problems. The valuation of inventory is possibly incorrect. Right? It's not reflected appropriately in the financial statements. Right? So what would cause them not to move inventory? First of all, why are you buying inventory if you're not moving it? And is there a possible obsolescence problem? Okay. So inventory, there's a potential overvaluation of inventory. Is the company engaging in inventory stockpiling? Why? Like, what would be the business reasons? So you would talk to management about why the inventory is going up. Are they stockpiling? Talk to and you're not doing inventory as a part of your substantive audit procedures, but you would talk to people in the warehouse about movement of inventory. Is there potential for obsolescence? Right? You might break it down by inventory product to see if it's any, is there a particular product where the inventory is not moving. So again, you'd have to get more information as to why that number would go up and be able to determine whether or not there's an obsolescence issue. So if the inventory is not moving, again, why is it increasing significantly from the prior year? Okay. So some of the ratios that you would look for, you would perform. Some of you did ratio analysis, some of you didn't, but you want to do some basic ratio analysis, and I'm not going to go into the definitions of these ratios because you should know these. But the current ratio, debt to equity ratio seems not huge changes in those. So you would want to evaluate whether or not that makes sense given what you've learned from your preliminary planning, your engagement planning, going through the board of director minutes. You know that there's been some changes in their liabilities, right? And they increased their debt. But what we already talked about things like the asset turnover. You see this number has changed significantly, decreased. You see that liability turnover, days sales, we already talked about days sales and inventory, days sales and accounts receivable, and then you see this huge change in their net working capital. So those were, again, where ratio analysis would point to some potential problems that need to be investigated further. Some other points of interest, I pointed out that the accounts payable decreased by 58% from its common size. And so this is just not reasonable when you consider also that inventory increased and when you compare that against last year. So your concern here, what's your concern with liabilities, your overall concern? If management was going to commit fraud, what do you think that fraud might be with liabilities? What would be their objective? What's the impact of expenses and liabilities?
Well, you have more. I mean, a company normally wouldn't want high liabilities.
Right.
So that's why we count. Well, if they commit fraud in this case, that's why.
Right. So we saw liabilities go down. So they would be the overall concern that you have as an auditor with liabilities and expenses is that management, that they're understated, whether it's understated due to error or fraud. That's your overall concern, right? Because an understatement of expenses is going to increase your net income, right? That's the impact of expenses, yes.
That they were making a lot more, but they were happy to lower their costs.
Right.
Their expenses were lower than they were last year, but they're still getting more.
Right. Exactly. Good point. Understanding the relationship. That they were making more, producing more, but their costs didn't change. Your costs should change, that relationship. And also, if you remember in the board of director minutes, I think again the 630 minutes, what they talked about with sales, they were going to increase sales by 10%, meaning they were going to sell more, but yet cost of goods sold and sales were going to remain unchanged. Not sales, and expenses were going to remain unchanged. That doesn't seem to make sense. Right? Because for you to sell more, presumably, you're going to increase your selling expenses, right? You're going to certainly sell more inventory. Your cost of goods sold would change, would increase, right? And you would have possibly more advertising expenses. If you're going to sell more to customers, more sales expenses for your salespeople going out and selling it, so you'd have more expenses related to that process. So you would expect to see, it might not be a one-to-one increase, but you would expect to see that there's going to be some increase in cost of goods sold or expenses if you're increasing your sales. The other thing that's also of interest is taxes payable. All of the taxes payable accounts have zero balances. That doesn't seem likely, right? That they've recorded no taxes payable. They have to pay taxes, right? So you want to look at that. And again, this would impact their working capital ratio. The line of credit, you want to know why is the company taking down or drawing on such a line of credit. And when you consider that in connection with the fact that sales are stagnant, they're not collecting on accounts receivable, what would that raise a red flag for you? Not fraud, but just a general issue. Going concern, right? Are they having going concern problems? We'll talk more about the auditor report in that situation, but that's one of the things that the auditor is, as they're auditing, that this entity is going to continue in the next year, in the foreseeable, the next year, in a one-year time frame, that this company has the ability to continue as a going concern. It doesn't have to be 2 years out, 3 years out, 10 years out. Just next year out, can this company continue to operate? Right? Continue to and so one of the things you might be concerned with is the fact if they're not growing sales, they're not collecting, so now are they just borrowing money to keep afloat? Right? And then the other thing is what kinds of debt covenants go along with that. So what contractual obligations do they have if they've drawn down on this line of credit that their creditors are looking for in terms of, are they looking at any of the ratios that could impact the company? So remember, if the company doesn't meet it, what impact does that have on the company? So remember, those are the types of things that even though something might be quantitatively immaterial, the fact that they might have debt covenants or contractual covenants associated with debt, then that makes those items that changes it to a qualitative materiality benchmark. Also, what other expenses were they referring to when they decided to draw this amount down? They were very vague. So again, the auditor would want more information on that. Other thing is their stock. Their stock price hasn't increased in recent years. And so it's a publicly held company. People are, obviously analysts are probably following them. The market is at least following them. So does management have any incentives to try to manage market expectations? And so again, when we couple that information with what we see in terms of the changes in accounts receivable and in inventory and the relationships that don't make sense, that might give the auditor pause to say, okay, is it possible that there's management has incentives to manage the numbers or manage earnings? The company could be trying to make the financial situation seem better than it really is because of the stagnant stock price. And so you would want to see that they're not, you would see or wonder, okay, is that why they're not, we don't see an increase in the allowance for doubtful accounts, right? Because if that was the case, we would see an increase in bad debt expense. What would that have the effect of? Depressing income, net income. Allowance, inventory obsolescence, same thing. We would see net income being depressed. So that would just make problems that they're having even worse. So that's why we might not see that they're adjusting these accounts. They have incentives to try to manage earnings. And then the other thing is the market might just see through, right? Any analyst could pick up the financial statements and see the same relationships that the auditor is seeing and question it. So they might see through Apollo.